Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 71. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, just one topic for today. 5 lessons from money simplified. Peter is re-releasing his great book. A lot of awesome visuals in there. I picked out 5 lessons. There's probably 50 great lessons in there. Today, we're going to discuss 5 of them. So here's the book. I'm going to have the link in the show notes to where you can buy it on Amazon, available everywhere. Lesson number 1, cash is not king. And Peter, whenever it feels like there's a crisis or even a correction, you hear this phrase, cash is king, cash is king, cash is king. And cash can be king during those periods of time when there's volatility. But if you zoom out, cash really feels safe in the short run, but is not really safe in the long run. And I think your visual here in the book about adjusting what you would receive on a 1-year CD, adjusting it for taxes and inflation, the picture looks a lot different than just what you're receiving in interest income.
That's right. If you actually think about the cost of inflation, usually people are going to be losing money in cash. And the way I like to think about it is every dollar bill is going to work for somebody every single day. It's either going to work for you or it's going to work for somebody else. And usually if you've got it sitting in an account in cash, it's going to work for somebody else. It's throwing a shovel over its shoulder, and even though it's your dollar bill, it's going to work for somebody else. You want those dollar bills producing income for you, get them deployed always as quickly as possible. Over the long run, that's how you're going to win. You have to look at it like a repeatable decision. When I get cash, what should I do? Invest every single time. The majority of the time in the short run, you're going to be right. Over the long run, you're almost always going to be right. And the math will work dramatically in your favor versus making judgment calls on an ongoing basis.
And if we look at just cash versus the stock market, Peter, in the short run, the difference seems minimal. 8% is the average underperformance over 1 year. But if you go out 10 years, 157% difference of terms of underperformance. 30 years, 2,000%. It's very hard to understand the long-term compounding on that, but safe to say that over a 30-year period, if you're just putting your money under your mattress or in a checking account, you're talking about a huge underperformance versus being an owner.
And the compounding effect is very real, and the more time you have, the more it just gets out of control. And it's a real cost. People don't see this cost as much because, well, I'm getting something on my cash, so it feels like it's heading in the right direction. But the speed with which you're accumulating new dollars is dramatically higher if your money's deployed in a real asset like a stock or real estate or something that's going to grow at 3-4 times the rate of cash. And that's when you start to see, you go from 10 to 20 to 30 years, you start to see this very dramatic effect on the cost of sitting in cash.
I think for investors, we often talk about this rule of 72, Peter, and doubling your money. And if you visualize it this way, I think it's a lot clearer. The average over the last 100 years or so time it's taken for cash to double your money, and this is before taxes and inflation, of course, 22 years. And the stock market, we're talking about 7 years on average. And that's because the average annualized return is about 10% per year.
Yes, I mean, this chart to me illustrates perfectly exactly like taking everything we're talking about it and just translating it into reality. You take $1,000, you put it in the stock market, and on average, it's going to double in 7 years. If you leave it in cash, on average, it's going to double in 22 years. Very, very, very big difference.
Lesson number 2, buy the haystack. But people want to find that needle, Peter. People want to find the needle. They want to find the next Apple, the next Microsoft. The difficulty, of course, as you showed in this visual from your book, is that the leaders often change from decade to decade.
I think the thing about the leaders is in every decade, people think, well, this is different. I mean, this group of firms, how in the world could they ever be replaced? I'm old enough to remember 2000. You had General Electric, ExxonMobil, Pfizer, Citi, Cisco. There's a lot of stories in here. A lot of very dramatic stories, winners and losers. Today, coming into this decade, Microsoft, Apple, Amazon, Google, Facebook, hard to imagine a different world. I think even until about 6 months ago, it was hard to imagine a different world. Now, with AI, Some of these firms, their moats are in real question here, and it'll be very, very interesting to see what the top five looks like 5, 10 years from now.
The difficulty, Peter, for investors is we are human beings and we look at recent performance as an indication of what will happen in the future. And so a lot of the big firms that we're familiar with today have had the best 10-year returns in the stock market. We're talking about Nvidia, of course, which noticeably, Peter, wasn't on that 2020 list at all. And all of a sudden now is the biggest company in the world. But we'll get to that in a little bit. But 23,000% return, and you have all the other Mag 7 names widely outperforming the S&P 500 over the last decade. But here's the thing investors should understand, Peter. It's that a very small percentage of stocks over the long run, which say the last 100 years, have contributed to the vast majority of shareholder wealth over time. We're talking about the top 10 stocks here contributing 29% of the overall returns. So the big question, Peter, is do you feel lucky in the sense that you can pick the few stocks that are going to drive the returns in the future? Because if you can't, the problem with trying to pick a few stocks and that's your entire portfolio is you might miss out on the next Nvidia, the next Broadcom, the next Meta, et cetera, et cetera.
I mean, I think about this like a movie slate. Like you think about a major studio in Hollywood, they don't go, we're going to do one or two or three movies. The little guys that aren't sophisticated do that either because they can't afford to or they just don't understand the industry. The big dogs release a whole bunch of movies, knowing they just need one, massive blockbuster to lift up the overall returns or two, and they can break even or lose money on the rest. I think if you look at investing, I mean, a lot of people go, well, gosh, NVIDIA did everything. Why don't I just go find the NVIDIA? Well, at the time, it didn't look like NVIDIA was the company. It looked like the company was Apple, Google, all these other companies that were doing really well. But if you owned the S&P 500, you had NVIDIA. And people were saying, well, gosh, the S&P's been on this amazing tear, but it's all because of NVIDIA and a couple other stocks. Yes, exactly. That's why you own all of them. And we have almost certainty we're going to catch the next NVIDIA because of it. So you have this spectrum of I'm going to go try to pick 5, 10 stocks and hope the next massive winner is in there. And by the way, it's not always a tech stock. At one point, it was Monster Energy. Another point, it was Southwest Airlines. That you're going to pick this one that's going to go up thousands of percent. We have a long history of seeing professionals resoundingly being incapable of that, right? Or you can say, I'm going to buy this basket. I'm going to capture the next NVIDIA. I'm going to capture the next Southwest. I'm going to capture the next Apple that's going to lift up the overall returns. It's very easy to see why that diversified approach has absolutely annihilated the stock picker approach over the last 10 and 20 years.
Yeah, and just a stunning visual here. Less than 4% of the companies in the stock market over the last 100 years, you're talking about 29,000 stocks, Peter, less than 4% of them contributed all of the shareholder wealth. So the remaining stocks on net contributed nothing. So you really have to get that right. And the only way to ensure you're going to own that 3.7% of stocks is to own everything. And on your point, in terms of the professionals have a difficult time doing that, I think that's an understatement here, because if you look at the percentage of equity funds underperforming their benchmarks on a risk adjusted basis, over 3 years, 88% underperformed, 10 years, 96% underperformed, over a 20-year period. And Peter, these are people trying to pick the best stocks every single day. 98% of them underperform their benchmarks over a 20-year period.
Yeah, like John Bogle said, quit looking for the needle in the haystack, buy the haystack.
Absolutely. And if you think that what we said earlier, cash is not king, so I'll just pick any individual stock, that does not apply to individual stock picking. It applies to having a diversified portfolio, because this is another stunning stat here, Peter. 59% of stocks in the last 100 years have actually underperformed simple, boring treasury bills. So the odds are not in your favor if you're picking any individual stock and looking to outperform. Let's go to lesson number 3 here. Check your home bias. We all have this home bias, Peter. We want to buy what we know, what's around us. If you look at Americans, we do it. 75 to 80% of our money is in U.S. stocks. People around the world do the same thing. It's amazing to see it. You have this visual looking at all different countries, and every single one of them does the same thing, Peter. They own a higher percentage of their home country stocks than what would be indicated in a global index.
It's just human nature that people, the Swedes own a bunch of Swedish stock, and the Canadians have 60% of their portfolio in Canadian stock, and Americans have 75% of their portfolio in US stocks. It's just human nature. But you wind up with, obviously, you're dependent, you've got a somewhat of dependence on what's going on in your country politically, tax wise, regulatory wise. You also have a lot of currency concentration in obviously in your home currency. And sometimes you have industry concentration. So, for example, I know some Canadians listen to this podcast. If you're invested in only Canadian indexes or Canadian stocks, you're probably overweighted commodities, like energy, and you might be overweighted banking, for example, like heavily overweighted, which would result in dramatic underperformance for 15 of the last 20 years. So, really try to take those eggs and spread them in baskets across the world is the right approach. And obviously we're seeing that now, Charlie.
Yeah, for sure. And the best lesson I think on this, Peter, would have to be Japan. Where it peaked in 1990 and essentially after a huge drawdown along the way went nowhere until hitting a new all-time high last year. I mean, there can't be a better example than this. It seemed like it could do no wrong. If you lived in Japan at the time, you probably said, I really don't need to own anything else. Japan's doing better than everything. I know all the companies in here. And then you fast forward we talk about lost decade, you're talking about lost decades here. This is the extreme example, but I think it's important for investors to understand this could happen with any individual country.
Yes, and I think the thing about Japan that's stunning is the world was writing books about their businesses and their markets being the gold standard replacing the United States. This isn't a random country that's an example. This was considered the leader of the future when all of this began.
Yeah, and the answer, this was, of course, one of the biggest massive bubbles of all time. And what I always say, the answer to a bubble is not don't invest, it's to diversify even further. And that was the big lesson from this example here, because international stocks outside of Japan had a tremendous few decades following the period where Japan peaked. So it did not indicate that everything was going to go down together. It didn't. It was an isolated bubble, and you saw the benefits of diversification. But Peter, today, the big challenge for particularly US investors has been this long period of rolling outperformance of US stocks versus international stocks. 15 years now of rolling 5-year outperformance from US stocks. That's by far the longest period in history. So, in terms of home bias, it seems like if you're looking at this period here, you're probably saying to yourself, well, it's helped me to have that bias. So why shouldn't I continue to have that bias going forward?
Well, unfortunately, they don't ring a bell at the top, right? Or when the rotation is going to happen. And it can really, really, really hurt. As this next chart shows, US stocks continue to do well, up 21% over the last 16 months or so. But emerging market stocks, 52.3%. European stocks, 44%. Absolutely crushing the US. One of the biggest, widest outperformances of all time. And, obviously, if you're concentrated in the US, you're missing this in a big, big way.
Yeah, and to be clear here, we have no idea if this is going to continue, if it's going to reverse. It could do any of the above, which is why you need to diversify, because we have no idea what the future will bring. Let's go to lesson number 4 here. Don't fear new highs. And you have this saying in your book, the stock market's at an all-time high, so I don't want to buy anything right now. This is something we can all be familiar with, Peter, because we hear that saying, buy low, sell high. So when the market's hitting a new high, as it did yesterday, people are saying, well, shouldn't I sell? And that's a very difficult, challenging thing for people to understand, that a new all-time high is not by itself a bearish signal.
I think the headline "new all-time high" gets people to think, "Oh, it's at the top. Maybe I should pause. Maybe I shouldn't invest as much. Maybe I should wait for it to pull back." But the stock market's at an all-time high, depending on what period you want to look at, but about 1 in 19 days. In other words, all the time. kind of like all the products we buy are at an all-time high almost all the time. Yet we're surprised when the companies that own those products hit all-time highs. Yes, the McDonald's value meal is at an all-time high. The ticket on Southwest Airlines is an all-time high. The pass to Disney World's at an all-time high. Our jaws shouldn't drop when their company stock is at an all-time high too. Part of this is just inflation built into the markets.
Right. Earnings rise over time. You should expect stock prices to rise over time. There will be an all-time high, Peter, as we know. That will be the last all-time high before a bear market, but that doesn't mean the last all-time high ever. And in terms of stunning data points, I don't think there's anything more stunning than this. Looking back to the start of the S&P Total Return Index in 1989, guess what? All-time highs have actually shown better forward returns over the next 1, 3, and 5 years than other days, any random day. This is kind of remarkable to see.
Yeah, this is a surprising chart that I remember when I first, learned about this, really had to dig in deeper, but it's, a little bit could be coincidence, a little bit the momentum effect. When things are moving, they tend to keep moving in that direction, trend in that direction for a little while. Certainly not in a way that can be market timed or predicted, but it's a definitely example that don't fear investing at all-time highs. Over the long run, the math's in your favor.
Yeah, there's nothing in the data to suggest that this all-time high isn't going to be followed by more all-time highs. In fact, the opposite is true. More than likely, a year from now will be higher. Will there be times when that's not true? Absolutely. But just because you're at an all-time high is definitely not a reason by itself to sell. Let's go to the last lesson here. Volatility is opportunity, Peter. Every generation has its share of volatility. Great Depression, you got the tech crisis, financial crisis, trade wars, pandemics. All of them seem very scary in the short run. And then inevitably there's an end and you see this enormous bounce back after that period of higher volatility.
Yeah, a lot of people think when the market's down, oh gosh, it's going to take me forever, at X rate of return to get back to break even. But it's kind of like a roadblock. I mean, the traffic's not moving because something's in the way. And when you remove what's in the way, the traffic doesn't take 5 hours to get back, going. It finds its way and then it's back to full speed. And that's how it is with the markets. COVID, we're all going to die. Wait a second, we're not all going to die. Okay, let's go back to McDonald's and Disney World. And that's pretty much the same thing with all of these bear market 9/11. When the cocooning effect is over, people go spend again. It's that waiting for that cloud to lift, the sunny skies, and then boom, it moves so fast. And if you wait for the sky to be clear, it's over. You would have permanently missed the upswing.
Yeah, and on that point, I want to rewind to last year, Peter. It was only a year ago. We had the bear market from the tariff situation. We had that volatility spike. We showed this chart here. And this was part of our few signal or noises where he said, this is probably a signal. I'm showing you here all of the closes for the volatility index, the VIX above 50. And historically, you'd always seen a positive return looking out the next year. And guess what? 38% increase from that close above 50 last April. Does this surprise you?
It doesn't surprise me at all. And I remember you calling this out as a signal, as you said, as you rarely do. And of course, it played out.
What's interesting is when I posted this on X, Peter, if you look at the ratio of negative comments to positive comments, it was probably like 99-1 in terms of people saying this time is different. Don't you understand why this is different than these other examples? And it always feels different when you're living in the midst of it, doesn't it?
Yeah, negative comments on Twitter. I'm completely shocked. No, I agree. Anytime I'm posting in a bear market, I'm slaughtered more than more than just your typical day where it's just a couple knife wounds.
It's hard to see the light, which is why that you have to really just go back to the data. And what I'd say in terms of the VIX, the volatility this year, we got as high as 31. Not a huge spike, but even at those levels, you tend to see better returns. But really, the best opportunities historically for investors is when the VIX spikes to 40 or 50. You see really massive outperformance going forward, which is really reinforcing Buffett's adage, be greedy when others are fearful. So as sure as we're talking today, there's going to be another VIX spike. There's going to be more volatility coming. And when it comes, learn to embrace that risk. And last chart here in terms of timing, Peter, because I think this is an important concept that you often talk about. If you tried to time that bear market last year, well, what has happened since then? What usually happens is the advance off of the low has not been linear, and that's why it's so extremely difficult to time these things.
Yeah, it's just impossible. And this chart's another great example of just don't miss the upside. Don't make the mistake that keeps you out of the market when things turn.
Absolutely. Okay, so there we have it. 5 lessons from Peter's great book, Money Simplified. Go out and get a copy today. I'll have a link in the show notes. Thank you, everyone, for joining us on Signal or Noise. If you're watching this on YouTube, hit that subscribe button. We're also available on Apple and Spotify. And Peter and I will see you next time on Signal or Noise.